Okay, no.
Tesla stock continuing to climb as we start the new year. In fact, if you check things out today, you're going to see the shares are up again this morning, up about 2.1%, another $8.78 to $427.11. And a new note this morning, Wedbush Securities says that the Chinese market could be worth up to $100 a share for Tesla. Dan Ives is here, joining us right now to talk more about that and why he's thinking that. Why do you think the Chinese market is going to be such a big deal for Tesla?
I mean, it's really on two sides. It's the production and the demand side. Giga 3 is really the linchpin for success for Tesla over the next 12 to 18 months. And I think it really comes down to demand. That could be another 100, 150K units per year. That's why right now a big part of what you're seeing in the stock is China. I think China's worth $75 to $100 per share. Now it's really a prove me story.
What do you know about what's happening in the factory there? People have raised questions about whether things are being manufactured there or whether they're really being manufactured here and kind of put together there. What have you seen? Have they let anybody in? Yeah,
in terms of component parts, and we've obviously done a lot of work over there as well as in Asia. You know, I think right now, even though 30–40% of component parts are Chinese made, that's going to continue to increase. I think it really comes down from an investor perspective. It's what's the production look like? 1,000 cars per week. Right now, they could be on the trajectory to 2,000 to 3,000 by the end of the year. That's really the key. That's why right now in Tesla, ultimately, take out U.S. and Europe going forward. Fork in the road. If they could be successful in China right now, it looks like they can. That's why I think right now, in our opinion, China is really the hearts and lungs of the bull story for Musk and company going forward.
You know, I want to talk to you about a bunch of the other predictions that you have for this year. There's some very interesting ones. First of all, one of the issues you are concerned about is this new law that just went into effect in California that will require companies like Uber and Lyft and others to pay their contractors as full-time employees, or to treat them as employees rather than contractors. What do you think that means?
Yeah, I think AB5, it's really a gut punch to the gig economy, not just Uber and Lyft. And fundamentally, the whole worker contract issue, which just got put, in California, it's going to be fought in the courts. But if you look at what that could do, it's a major change to the business models. And that's why right now, I think that's an $8 to $10 overhang on Uber itself in terms of AB5. So this is something, in our opinion, we're following very closely, because AB5, and especially how it plays out in the courts, that's going to be significant.
What do you think happens in the courts?
Look, ultimately, we believe in the courts. It is ruled unconstitutional, and ultimately it does not get implemented. That's at least in terms of how we see, and that's our view. If we thought AB5 is going to be implemented in its current form, it's hard to be bullish on these names, in our opinion.
So if you think that's the case, should people buy right now if it's an $8 to $10 overhang in the stock?
Yeah, in my opinion, that's more the table pounder in terms of these gig names to buy into 2020. I look at Uber and specifically Lyft. That's when I think fundamentals are going to increase. Right now, it's a glass half empty view, a lot of risk out there in terms of perceived on the names. But I think fundamentally and valuation-wise, these are names that go much higher if we sit here a year from now, especially our view on AB5 and how that ultimately shakes out.
However, you also have one of your predictions for this year that Uber winds up having to really scale back on Uber Eats.
Yeah, that's a major overhang. If you look right now, one of the biggest overhangs besides AB5 is that food delivery business. It was viewed as an asset if you go back to when they came public. But right now, in terms of what we're seeing with Grubhub, DoorDash, and others, so much pressure on profitability. And if you look for
because there's so much competition.
Because there's competition, take rates continue to be under pressure. And for a company where Dara's basically put out there 2021 profitability, in my opinion, they're going to have to significantly curtail it or potentially shut it down in terms of Uber Eats.
What about the FAANG names and which ones you think will do well in 2020? You think Apple's still going to be a big winner?
Yeah, I think Apple, we sit here a year from now north of 350. I just continue to believe, in terms of all of our work, that 5G super cycle is real. And I think it comes down to that install base. It's a valuation that continues to, I think, re-rate higher on services. But I think fundamentally in 5G, you could talk about Qualcomm and others. Best 5G play, in our opinion, is Apple. But then you also look at a name like Amazon. I think the reason that's going to work is really some of the parts on the cloud piece. I think the other theme, it's part why we're so bullish on Microsoft, but it's that cloud piece. I think AWS cloud piece for Amazon is going to be the next leg of that bull thesis.
So that's the next leg of it, but you also think that Microsoft is the winner in the next go-around of the cloud wars.
No doubt. I mean, if I look right now, it's going to be a two-horse race, AWS and Microsoft. I think the AWS is going to help Amazon re-rate. But in terms of the golden touch, who's going to win the next phase of cloud, forget Google. I think it's Microsoft and Nadella. And in our opinion, that's a stock that continues to go higher because in this next phase of cloud, you only have 30% of workloads in the cloud today. When that goes to 55% in the next 2 years, it's Redmond and Nadella that win that. And that's why Microsoft, in our opinion, continues to be our best cloud play, just like Apple's our 5G play.
But you still like Amazon shares because you think that the cloud play there will continue to be a reason to buy the stock?
It's really numbers. If I look at $300 billion has been spent on the cloud, call it the last 6 years. The next 3 years, $700 billion. The numbers are so big that right now it's going to lift both Microsoft and Amazon. I think if you look at the AWS piece, that's going to be something Amazon's going to get aggressive, not just organically, but through acquisitions. So that's why in terms of the transformational trends, it's really cloud. And that's also why one of our predictions, I think Google is going to look to acquire a big cloud player. You look at names like Workday and ServiceNow and others.
You think they could get that passed with all the questions about already looking from regulators saying maybe we want to break up, or from politicians, I should say, saying we want to break up some of these companies? Would they be allowed to do a purchase like that?
Well, I think that would obviously be under scrutiny. But I do believe in terms of FAANG names, you will start to see them get more aggressive on acquisitions rather than more defensive. And I just go back to
Is that smart or is that tone deaf given the regulatory environment and given the political environment today?
It's a great point. And I think, no doubt, they could take heat in the kitchen. But I go back to covering Microsoft back in the late 90s. I think Gates will say to this day, one of their biggest strategic mistakes is when they were under the bright spotlight, they went defensive. They didn't acquire, especially in mobile and some other areas, and it hurt them for a decade plus. So I do believe these FAANG names are going to get more aggressive on M&A, even though you could say there's going to be a lot more heat in the Beltway.
But you think it's the right thing to do?
But I think it's the right thing to do strategically because right now you look, healthcare, banking, cloud, you're going to continue to see these names go on the offensive rather than the defensive, and I think that's going to be a tone set early on in terms of a potential mega merger.
Are there any stocks you don't like in your universe of coverage at this point?
Yeah, front and center is Slack, just because I view it goes to the Microsoft theme. Going against Microsoft right here is going to be extremely difficult for Slack. That's why I think that's one where growth's overstated. We continue to have a sell rating on that. And I view it as there's not going to be all winners. There's going to be inherent losers. And I think where Slack is negative. And even when I look at content, in terms of how positively positioned I view a Disney, it's more cautious on a Netflix, just given where they sit from a content and sub perspective.
Wait, you're more cautious on Disney or on Netflix?
On Netflix. On
Netflix because of Disney.
Because of Disney. When I look at Iger and Disney and I look at sub growth and what's happened there in content, in terms of FAANG names, that's why Apple, Amazon, Google, to me, stick out more bullish than a Facebook, just given some of those content headwinds. And I think sub growth that they're going to have to face, especially with what I view as pricing hubris in terms of the current model.
All right, so of all the names you do like, which one is your favorite? Do you have a top pick?
Top pick, front and center right here is Apple. Even though I view it as, you say stock's up 8%, that's just the first part of what I view as a massive re-rating. That's where I think $350 to $400 as we go into next year is the one that sticks out.